In the third and final part of our interview with RateSetter, we're going to look at regulation. We're going to look at what could go wrong if we have a recession in the UK, because that could increase the default rates on the loans which you're funding. And then finally, we'll look at the way that RateSetter is different from its peers, because there are now many peer-to-peer lenders in the UK market. So here's Marco to explain more. Now, obviously, regulation's important to keep people from misbehaving. You're covered by the Financial Conduct Authority, so obviously there's a complaints procedure involved in that, but you're not covered by the FSCS, the Financial Services Compensation Scheme. So the government doesn't guarantee deposits with your company. Is that right?
That's absolutely correct. So we are completely regulated by the Financial Conduct Authority, and as other financial institutions are. However, we are not covered by the Financial Services Compensation Scheme, which is essentially an insurance that the government has with banks for money that is deposited in savings accounts. RateSetter is an investment product. So much like one's investments in equities, stocks and shares, for want of another word, aren't covered by FSCS. Well, neither are they covered with RateSetter.
Okay. And then drilling into the risk a little bit, what are the current default rates? So let's say you lend out $1 million. What proportion of that money is defaulting at the moment? Because there's got to be some kind of default rate, right?
Yes, yes. So the historical default rates are around about 3%. But I guess I'll clarify, because default means a lot of things to different people. What we use is expected loss, and that perhaps may be the best measure of assessing our performance and consistency with how our product works. So our expected loss rate is 3%. So for every £100 invested in RateSetter, £3 of that is bad debt, so that's roughly what it is. And we've seen it in some years it goes up, and some years it goes down. Now, whether it goes up or down isn't actually a terribly useful measure of loan performance, because the provision fund is funded, is there to cover the poor performance of the loans. So what's actually important here is that we have appropriately provisioned for the bad debt, and therefore we've got a sufficient buffer for it. If we are,
you actually have a forward-looking model, don't you? Or do you provision
absolutely
based on historical defaults?
So we've got a forward-looking model, but we also provision based on historical performance. So what I would say is we employ all the tools that the other financial institutions use, both in the forecasting of loan performance, as well as at the very initial stage of managing for that credit performance. So that would be when we screen for the borrowers and ensure that we are lending to people who can afford to borrow and can afford the repayments, and that we're performing on behalf of our investors as a responsible lender. So in that sense, everyone wins. We're lending out to borrowers who can afford to borrow, and we get a loan book that performs well for our investors. But I care to clarify that point about the actual percentage of expected loss is largely irrelevant, because if our loan book has got an expected loss of 3%, however, we've put 4% into the provision fund, every investor is going to get the return that they expected exactly.
Now, obviously, the period over which you've existed has been fairly benign in terms of economic growth. But if we were to see a recession, and obviously at some point we will see a recession, what would you expect to happen to the default rates? And do you think the provision fund would be capable of dealing with it?
Sure. So We probably would see an increase in default rates if there was a recession. And as you say, indeed, there will be a recession. When there is a recession, one would expect default rates to increase. So the question is whether we will have done a sufficiently thorough job in assessing the performance of those loans when we onboarded them. And the second thing is about whether we have sufficiently provisioned in the provision fund. What I would say as well is that what's important is diversification of the loans. So we are the biggest peer-to-peer lender in terms of number of customers, and our loans are diversified, or an investor's loans will be diversified across different loan profiles, and those will therefore perform differently, and will be well positioned to go through a recession. That just gets us as setting the scene. In terms of what would happen if the loans deteriorated beyond what we had expected, so the expected losses were greater than we expected, well, once again, the provision fund would cover, would be a buffer to a certain extent. Then there'd be the interest that is expected. That would be a second buffer. So perhaps one's expected interest to be reduced. I expected to earn 4%, I'll only earn 3% because the provision fund is being replenished. And then beyond that, if we're talking about a very severe recession or period of poor credit performance, then actually capital would start to be eroded. So there were, let's say the bad debt had increased. It went from 3% to 8%. We then need to start taking some capital to cover for that bad debt. However, we're still talking, I think, in relative terms, about a safe investment relative to other products like equities. For a prolonged and severe recession, we know what happens in the stock market. Equities tend to suffer immediately and significantly. So the fact that we've got several layers of buffers, and then capital is hit, and it would only be hit by as much as the expected losses, I think underlines how RateSetter perhaps won't have the stellar returns that one can achieve in funds and equities. However, it is a much lower risk product.
Okay. One last question. Obviously, since RateSetter has been around for a very long time, you're very well established. But it's like whack-a-mole, I guess, for you guys, because there's a new crowdfunding platform or a new peer-to-peer lender popping up all the time. How would you describe yourself relative to your peers? I know this is a difficult question, but what sets you apart, do you think? So
what is absolutely critical with a new category is trust. And in financial services, that is particularly important. People are very, very careful, and rightly so, with where they put their money. As speaking personally, I choose to invest in products that have a track record. I choose to invest with brands that have a track record. And that's really what's setting RateSetter apart. From the start, we can say that we have got a strong track record. We've lent £2.5 billion on behalf of our investors. That's not small change. And we have a 100% track record on that. No other peer-to-peer lender, possibly in the world, can say that. 100%, no one can say that in the UK. So I think that is what sets RateSetter apart in terms of the consideration for people who are looking to invest into this category of peer-to-peer. There are also specifics about our product which are different, such as the fact that we are a market, which and the market rate will change with supply and demand. With others, the rate is perhaps fixed, and that has merits and has certain drawbacks. We think having a veritable exchange that is reflected also in the rate that a lender can earn is very important. So there are differences which we feel quite passionate about, but I guess the important thing, as you're saying, there's so many new companies and so much innovation happening. What sets us apart? It is the track record. I'm not saying that to disparage others who've got a shorter track record in any way, and I would say that innovation is good. At one point when we started, we didn't have a track record, but it's with hindsight that one can say they put their money in the right place, and I think investors that put their money in the RateSetter years ago are confident now in saying that they backed the right horse.
So one of the new things that you offer now is an innovative finance ISA. Now, this is a kind of tax wrapper around your products. Could you say which products that can cover and how it helps investors?
That is a very good question. We're asked that by many investors, and I think what they're expecting to hear is that because there's a tax benefit, then therefore the returns might be lower. And I'm very pleased to say that we have the ISA is a tax wrapper around a RateSetter investment. So you can open up an ISA, an innovative finance ISA with a RateSetter, and you get a tax-free treatment for that £20,000, and that is across any of the markets that you choose to invest in at RateSetter. So the returns are exactly the same that you can access with and without the ISA. However, you get the benefit that it's tax-free. So customers
tell the tax man about it. So when I tell my accountant about my finances at the end of the year, he doesn't even have to hear about that one.
Absolutely.
Okay, well, that's been great. Thank you very much for your time, Mario. That's been fantastic. And
thank you.
I look forward to seeing any new developments from RateSetter in the future. Thank you.
Well, we look forward to putting them out. Thank you so much.
Thank you. I hope you found that video useful and informative. Please support us by clicking on the Patreon link, and if you don't want to miss any of our videos, then subscribe to our channel on YouTube.